There's a video that went viral recently. A woman telling people to retire as soon as they responsibly can. And she's right. Time is your most valuable asset. You can always make more money. You cannot make more time. But here's the problem nobody in that conversation is talking about. What happens to your money between now and the day you actually stop working? Because right now, we've got a war in the Middle East, spiking oil past $100 a barrel, a Fed that just froze rates for the second time in a row, inflation that refuses to die, and a social security trust fund barreling toward insolvency by 2033. So today, I'm going to give you a framework, 3 steps, to protect and grow your retirement money in this specific environment. Because retiring soon only works if your money survives long enough to get you there. I'm Jessica, and I spend an unreasonable amount of time reading Federal Reserve transcripts, economic data releases, and research papers so that I can share what I find with you. Because I think more people need to understand what's actually going on with the markets, not just what the headlines tell them. I'm not a financial advisor. I don't manage your money. But I do believe that if you're an everyday investor trying to figure out how to get from here to retirement without getting wrecked, you deserve to hear the unfiltered version of what's happening. Not the CNBC-approved "don't scare the viewers" version, the real one. So let's get into it. I call this the Retirement Survival Framework, and it has 3 steps. Step 1. Understand the battlefield. Before you can protect your money, you need to know what's shooting at it. There are 3 big forces working against the average American investor. Force number 1, the Iran war and the oil shock. On February 28, 2026, joint US-Israeli airstrikes hit Iran. Within days, Brent crude oil, which had been sitting around $70 a barrel, shot past $110. As of this week, it's still hovering around $100 to $106. Now, why should you care? Because oil prices are basically a tax on everything. When oil goes up, gas goes up. When gas goes up, shipping costs go up. When shipping goes up, the price of your groceries, your clothes, your Amazon packages, all of it goes up. The national average for a gallon of gas jumped from $2.89 to over $3.70 in under 3 weeks. That's a 28% spike. In California, some stations were charging over $5. A few places in LA hit $8 a gallon. $8. And this matters for your portfolio because oil shocks do 2 things simultaneously. They push inflation higher and they slow economic growth. Economists have a fun little word for that combination. It's called stagflation. It's like getting a pay cut and a price increase at the same time. The Strait of Hormuz, that narrow waterway where about 20% of the world's oil passes through, has been effectively disrupted. Qatar halted gas production. Oil output from the Gulf dropped by over 10 million barrels per day within the first 2 weeks. This is the largest supply disruption in the history of the global oil market. So if you're sitting there thinking, wars don't affect my 401k, they do. This one already has. The S&P 500 is down about 3.2% year to date. And that's before the full economic impact of 100 plus oil starts showing up in corporate earnings. Force number 2, the Fed's impossible position. Let's talk about our friends at the Federal Reserve. The Fed held rates steady at 3.5% to 3.75%. The vote was 11 to 1. Only one person wanted to cut. Everyone else said, nope, we're staying put. Now remember, the whole promise of 2025 and early 2026 was supposed to be inflation comes down, the Fed cuts rates, markets celebrate, everyone's happy. That was the script Wall Street was reading from. Here's what actually happened. Inflation is still at 2.4% on CPI, but the Fed's own projections just bumped their year-end forecast to 2.7%. The Producer Price Index, what businesses pay, came in at 3.4% in February, which is higher than expected. And now the Iran war is pouring gasoline, literally, on the inflation fire. So the Fed is stuck. If they cut rates to help the economy, they risk making inflation worse. If they hold rates or raise them, they risk tipping us into a recession. Chair Powell basically said yesterday, "We need to see progress on tariff-related inflation before we can assess energy-related inflation." Translation, we have no idea what's happening, so we're going to sit here and stare at the data. Meanwhile, Powell's term ends in May. Trump has nominated Kevin Warsh to replace him. Powell says he's staying on the board until a DOJ investigation, which he says is a pretext to pressure him on rates, is resolved. It's messy. It's political. It's exactly what you'd expect. The dot plot, which is the chart that shows where each Fed official thinks rates will be, still projects one rate cut this year. But traders are now pricing the first cut for September at the earliest. So if you were betting on lower rates to boost your stock portfolio, you're going to be waiting a while. Force number 3, the national debt time bomb. Here's the number nobody wants to talk about at dinner parties. $38.86 trillion. That's the US national debt as of March 4th, 2026. It went up $2.64 trillion in the past year alone. That works out to about $7.2 billion per day. Every single day. Why does this matter for you? 2 reasons. First, the interest payments. Through February 2026, the federal government has already paid $425 billion just in interest on the debt, and we're only 5 months into the fiscal year. The average interest rate on the national debt is 3.35%. Net interest is now 13.85% of all federal spending. The Congressional Budget Office projects interest payments will hit $1 trillion this year and $2.1 trillion by 2036. That's money that doesn't go to Social Security, doesn't go to Medicare, doesn't go to infrastructure. It just goes to the people who loaned us the money. It's like paying the minimum on a credit card, except the credit card is the entire country. Second, and this one's going to sting, the Social Security Trust Fund. The OASI Trust Fund, the one that pays your retirement and survivor benefits, is now projected to be depleted by 2033. That's 7 years away. When it runs out, if Congress does nothing, and doing nothing is what Congress does best, your benefits get automatically cut by about 24%. Think about that. If you're a typical couple planning to retire around that time, that's a cut of roughly $18,400 a year. That's not a rounding error, that's a lifestyle change. And it's accelerating because of recent legislation. The One Big Beautiful Bill Act cost Social Security about $168 billion over 10 years in lost revenue. The Social Security Fairness Act added another $200 billion in obligations. Both bipartisan, both popular, both bringing the system closer to a cliff. Okay, that was a lot, and we're only on step 1. This video is information dense, and I want to make sure you get it all down. So I made a workbook for you that you can download. It has all the data, the framework, the action items, everything we're going to cover today, organised so you can actually use it. The link is in the description below. Grab that now and let's move to step 2. Step 2. Know your actual numbers. A lot of people romanticize early retirement without ever sitting down and doing the math. And the math right now in 2026 is challenging. Your 401k, where do you actually stand? Let's start with the number that matters most. What's in your retirement account? According to Fidelity, the average 401k balance at the end of 2025 was about $146,000. That's an 11% increase from the year before. Sounds great, right? But the median, which is a better picture of the typical person, is way lower. Across all age groups, the median 401k balance is below $100,000. Let me break that down by age using the most recent data. If you're in your 30s, the average is around $69,000, but the median is closer to $16,000 to $40,000, depending on the data source. In your 40s, the average is about $146,000, median around $40,000 to $67,000. In your 50s, supposedly your peak saving years, average is $247,000, median around $68,000 to $96,000. Those median numbers are the real ones. The averages are pulled up by the top 10%, the people who don't need this video. Now, financial planners generally say you need 10 times your annual salary saved by age 67 to replace about 80% of your pre-retirement income. So if you make $75,000 a year, you need $750,000. If you make $100,000, you need $1 million. Look at those median numbers again. We have a gap, a big one. The tariff tax you don't see now, layer in what tariffs are doing to your purchasing power. The Yale Budget Lab estimates that the current tariff regime is increasing consumer prices by about 0.6% to 1.0%, depending on whether temporary tariffs get extended. That translates to roughly $800 to $1,300 in extra annual costs per household. And here's the part that should make you. Tariffs are a regressive tax. If you're in the bottom 10% of earners, tariffs hit you 3 times harder as a percentage of your income compared to someone in the top 10%. The people who can least afford it pay the most. 70% of Americans, across all political affiliations, say tariffs have made things more expensive, because they have. Motor vehicles, up 12% in the short run. Apparel, up 21%. Leather goods like shoes, up 23%. These aren't theoretical numbers. This is your wallet, right now. So when someone says, retire soon, yes, absolutely. But also understand that the cost of living in retirement is higher than you probably budgeted for, and it's getting higher. The 4% rule under pressure. The classic retirement withdrawal strategy is the 4% rule. Withdraw 4% of your portfolio in year 1, adjust for inflation, and your money should last 30 years. Simple, right? Here's the problem. That rule was built for a world where inflation averaged around 2 to 3%, and the stock market returned about 10% on average. But what happens when inflation is stickier, like it is now, and market returns are lower? Rob Arnott, who runs Research Affiliates, warned just this week that S&P 500 shareholders might only see 3% annual returns for the next decade. Not 10%, 3%. He points to high valuations, mean reversion in earnings, and the overconcentration in a handful of mega-cap tech stocks. If he's right, and I'm not saying he is, but if he is, the 4% rule doesn't work anymore. You'd be withdrawing faster than your portfolio can grow. So what do? You stress test your plan. You run the numbers assuming 5 to 6% inflation instead of 3%. You assume 5% market returns instead of 10%. You factor in a potential 24% cut to Social Security. And if your plan still works under those conditions, then you can retire soon with confidence. If it doesn't work under those conditions, you're not broken, you just need to adjust. Maybe you work 2 more years. Maybe you shift your asset allocation. Maybe you downsize before retirement instead of after. But you need to know. Step 3. Position for what's coming. All right, we've covered the battlefield. We've done the math. Now the question is, what do you actually do with your money in this environment? I'm going to walk through 4 positioning ideas. Not financial advice. I'm not your advisor. but this is the kind of thinking that separates people who react to markets from people who are ready for them. Position number 1, respect the value of cash and short-term bonds. I know, cash is boring. Your uncle at Thanksgiving says cash is trash. Ray Dalio said it once and now it's on a bumper sticker. But right now, the 10-year Treasury yield is sitting at about 4.3%. You can get roughly 4 to 5% on short-term treasuries, money markets and high-yield savings accounts, with essentially zero risk. In a world where the S&P 500 is down 3% year to date and stocks are volatile, getting paid 4 to 5% to wait is not boring. That's intelligent. That's what professional investors call optionality. You get a return while you wait for better entry points. This is especially important if you're within 5 to 10 years of retirement. You do not want to be 100% in stocks when a war is spiking oil prices and the Fed doesn't know which way to turn. Having 6 to 12 months of expenses in cash or short-term bonds isn't fear, it's math. Position number 2, think about what benefits from chaos. When everything's uncertain, a few asset classes tend to do well, and the obvious one right now is gold. Gold hit an all-time high of $5,417 per ounce on March 3rd, 2026. Even after pulling back to around $4,800 to $5,100 this week, it's still up roughly 60 to 67% over the past year. Central banks around the world have been buying gold hand over fist, and they don't do that because they think everything's fine. They do it because they see what's coming. Now, I'm not saying go dump all your money into gold, but having 5 to 10% of your portfolio in gold or a gold ETF is a way to hedge against exactly the kind of mess we're in. War-driven inflation, currency uncertainty, and a government that adds $7 billion to the national debt every single day. Energy stocks are the other obvious beneficiary. Oil companies are printing money right now. When Brent crude is above $100, the large integrated energy companies, the Exxons, the Chevrons, generate enormous free cash flow. Their stock prices have been hitting all-time highs since the conflict began. But be careful here. Oil prices are volatile. They can spike on a headline and crash on a ceasefire rumour. If you're going to allocate to energy, think of it as a position you'd hold for the medium term, 1 to 3 years, not a day trade. Position number 3, don't ignore international diversification. American investors have a bad habit of thinking the US stock market is the only stock market. Understandable, it's been the best performer for over a decade. But Rob Arnott makes an interesting point. If US large cap stocks are set for 3% annual returns, where do you look? International developed markets and value stocks. They've been left for dead, which means they're cheaper. And cheaper starting valuations historically lead to higher future returns. Not guaranteed, but the math is on your side. Japan has been quietly outperforming. Europe is trading at lower multiples than the US. Emerging markets in Asia are less correlated with the Iran war. None of these are home runs by themselves, but together they provide something your all US, all tech portfolio doesn't. Diversification that actually works when it matters. Position number 4. Use the tax code while it's still favourable. The 2026 contribution limits for 401k plans went up to $24,500. That's your baseline. If you're 50 or older, you get an extra $8,000 in catch-up contributions, bringing your total to $32,500. And if you're between 60 and 63, there's now a super catch-up of $11,250 extra. That's $35,750 total. Max it out if you can. Every dollar you put in pre-tax reduces your taxable income today and compounds tax deferred until you withdraw it. In a year where the market is choppy and your returns might be modest, the tax savings alone can be worth more than the market return. Also, and this is something a lot of people don't think about, if you expect tax rates to go higher in the future, and with $38.86 trillion in debt, it's not exactly a wild guess, consider doing some Roth conversions now. Pay the tax today at current rates, and your future withdrawals are tax-free. It's like locking in today's gas prices before they go up, except with your entire tax bill. Let me bring this back to where we started. Michelle Meitler said something in her video that stuck with me. Every year you delay retirement isn't just one more year of working, it's one less year of your best retirement years. She's talking about your time, your energy, your health, and she's right. But here's what I'd add. Every year you delay preparing for retirement, not just emotionally, but financially, is a year where inflation is quietly eating your purchasing power, where your 401k might be earning less than you think, and where the systems you're counting on, like Social Security, are getting weaker, not stronger. Consumer sentiment right now is at 55.5 on the University of Michigan index. That's low. People are nervous. And when people are nervous, they freeze. They do nothing. Don't freeze. The 3 steps are simple. Understand the battlefield. Know what forces are working against your money. Know your actual numbers, not the fantasy version, the real one. And position for what's coming, not by panic selling or gambling, but by making deliberate, informed decisions about cash, gold, diversification, and tax strategy. You don't need to be a Wall Street trader to do this. You just need to pay attention and take it seriously. Because the institutions, the Fed, Congress, the big banks, they're all playing their own game. Their incentives are not your incentives. The Fed's job isn't to make you rich. Congress's job apparently isn't to keep Social Security funded. And Wall Street's job is to keep you invested so they can charge fees. Your job is to look out for yourself. And the good news is, you're watching this video, so you're already doing that. Before you go, remember that workbook I mentioned? It's got everything we covered today. The 3 forces working against your money, the retirement maths with real numbers, and the 4 positioning strategies with links to every source. You can download it free. The link is in the description. If this was useful, hit subscribe. I do this every week. Break down what's actually happening in the economy and markets, translate it into plain language, and tell you what I think it means for real investors. Not hedge fund managers, not day traders, people like you who are trying to build a life and protect what they've earned. I'll see you in the next one.